Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's PIFinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on again, Jim.
Drew, equity markets continue to move higher to start off the year. Do you think this is going to continue for some time?
Yeah, they definitely have. I mean, so far this year, I think the S&P is up about 10%, NASDAQ up about 12%. So when you say continue, can it continue at this rate? I definitely don't think so. I mean, that would be a doubling of the stock market this year if we continued on in this fashion. So I am looking at the market as I think it's overbought near term. I think the momentum's sort of carried it. But at the same time, we seem to keep finding reasons to goose it up a little bit more, whether that's, this week it seems to be Trump possibly signing a bill to not have another government shutdown, as well as with U.S. Trade representatives over in China, the possibility of moving forward on a trade deal with China and not having to impose those additional tariffs on March 1st, which is the current deadline, which could be moved. So there's always seemingly a little bit of hope to come into the market, but again, I think we're a little extended on this run moving higher. When I look across different asset classes, I see a few things that don't necessarily agree with the move the equity market has. One is the interest rate space, so bonds, really not following the same move that equities are having. But again, that's partially due to the dovish tilt that the Fed has come in with, which has also helped the equity market. So, rates aren't moving as high as they maybe would have normally. But again, I think rates staying lower tells me that maybe the bond market isn't fully buying this big move higher in the equity market. The other side is in the last 2 weeks, I mean, the U.S. dollar has just exploded higher. In currency terms, it's up almost 2 cents on the dollar index in that time. So 9 out of the last 10 trading days have been higher on the dollar index. That, to me, shows some underlying issues that, maybe things aren't as good as we think they are, and that is, even with the Fed maintaining its dovish tilt, the rest of the world also not looking so good, and I think you're seeing money come to the United States, and I do think some of that is going into equities and some of it going into bonds because, again, the interest rate in the U.S. is still so much better than you're getting most other places in the world at these times. So, and then the last one is crude oil. We had crude oil and equities trade sort of hand in hand, both topping out at the beginning of October, both bottoming Christmas, Boxing Day. But crude oil's really sort of run up and run into a consolidation band in sort of the $50 to $55 range, where equities have just continued to move higher. So a lot of different markets that I'm looking at are making me skeptical of this move in the equity market, and even more global equities are softer. So we're, again, seeing a bigger outperformance of the U.S. equity markets. And I think that could continue, but maybe not to the degree that we've seen so far this year. So a very long-winded answer, but short and sweet. I don't think we're going to maintain this pace of gains that we've seen this year in the U.S. equity markets. And my view is near term, we're likely to see a pullback from these high levels.
I think last year the old saying, sell in May and go away, worked out for a lot of people. However, now I'm hearing March might be the big decision month where we might see a big downturn. So, sell in March and, what rhymes with that? Sit on the porch?
Yes, not a poet, with the lyrics for that, but, I do think we could see something like that. I think that if we were to get a Chinese trade deal, which would be good for the global economy, I still think it could be a bit of buy the rumor, sell the news, is the old trader adage on that. And as much as a deal would help, is it going to completely turn things around? I mean, you look at the slowing of the economic data that we're seeing out of Germany, especially. Is a U.S. China trade deal going to turn that around? No. So I think that, they might be pricing in more good news than what a trade deal would actually be worth. It's a good thing, but it can't work miracles.
We'll have more with Drew Zimmerman right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, if interest rates are steady right now, do you think the Fed might be pressured to hike them again just to give them more wiggle room if the economy does take a stall and start to dive?
Well, I think that's part of the issue that we have right now is if you're looking at financial conditions, which largely mirror the equity market to some degree, you're seeing maybe the Fed kind of get boxed in. They want to be patient. They want to see more inflation, and especially because the labor market is staying very tight in the U.S. If equity markets continue to stay at these high levels, that the Fed may have to come back in, which in itself may cap the equity markets if the market has to start pricing in another interest rate hike. I mean, a lot of market economists seem to think the Fed has already hiked too much, possibly. But if the markets stay at these levels and employment stays strong, then I think you have to see the market go from pricing in no rate hikes in 2019 to start bringing one or two back into the forecast. But in doing that, you might see the equity market then start to sell off, which may then take that interest rate increase risk off the table. So a bit of a dynamic situation in how one can feed on the other. But I think that is part of maybe where you see a bit of a cap in the equity markets near term, is the market having to move in that direction. And I mean, we're definitely not seeing it in interest rates. I mean, interest rates are staying much lower if you consider the move that they had from the October highs when equities were at their highs to the lows that they got. I mean, we had the U.S. 10-year essentially at 3.25%, and everybody thought we would go a lot higher. And then it traded all the way back to 2.5%, a pretty dramatic move. And we've sort of moved back up higher off those lows, but definitely not anywhere in the same realm of how far equities have come off their lows from the Christmas time levels. So I expect that if we were to stay here for a few more weeks and see some more U.S. economic data that stayed at least strong, then the Fed may have to start getting priced back into the market. And again, I would think that would weigh on the equity market.
If the Fed has been so dovish lately, why has the U.S. dollar been so strong the past couple of weeks?
Yeah, as I mentioned before, I mean, 9 out of the last 10 trading days, the U.S. dollar has been stronger, back at around the 97 level on the index, and recently the high has been around 97.5. So if we were to go a little more, I mean, the U.S. dollar is very near 2-year high levels, which is fairly significant. And as much as the Fed has been dovish and the U.S. dollar did soften in and around that getting priced in, but once it was priced in, I think you have to look around the world, and in the world of currencies, one is always relative to the other. So if you don't want to own U.S. dollars, which currency do you want to own? And I think that's where you look around and realize that, if the U.S. is slowing a little bit, a lot of the other global economies are slowing even more. So you kind of have a relative outperformance that we're seeing in the U.S. equity market, but just in U.S. economic data as well. And then you've also got much higher interest rates in the U.S. So I mean, you've got the German 10-year bond, almost going back to zero. I mean, at levels that it hasn't been at since 2016. So if you can get 2.7% on a U.S. 10-year or 0.1% on a German 10-year in euros, I know where I'd want to put my money, especially if the slowing is more in Europe and that currency could depreciate more. So you have currency risk being in the euro, and you're not getting very much as far as yield if on safe paper, if that's what you're looking for. So as much as the Fed has been dovish, I think it's sort of the cleanest dirty shirt is the saying that goes with it. So in a relative currency game, I think the U.S. dollar and U.S. economics look better than what you're seeing elsewhere.
Are we lucky that the Canadian dollar has held in where it's been lately?
Yes, we are. I follow the Canadian dollar very closely, and I think it's still expensive. I think if you look at the other commodity currencies, especially the Australian dollar, they're having more issues in their economy after going, I think, decades now without a technical recession, but some more issues in their real estate market and a closer tie to China than the Canadian dollar has. But the Aussie currency is really struggling, down towards the 70-cent level, 71 cents here today, where Canada is still at 75.5 cents. So I think there has been an outperformance for Canada on the commodity currencies. Part of that is oil doing better, as well as the Alberta mandated production cuts on oil that really helped the differential that Canadians, or that the Albertan provinces were getting for their crude oil. I think there's some other issues with that, and the amount of incentive to have companies move oil out of Alberta is reduced, and we're seeing that now, that lower amounts may actually be leaving the province than before because of that differential being so narrow. But still, all in all, I think if Canada was following just its interest rate differential, again, on a 2-year piece of paper between Canada and the U.S., you're getting an extra 70 basis points in the U.S. right now. I think that should still drive flows, but as this equity market continues to move higher, it's a bellwether for investor sentiment, and if that's going higher, investor sentiment is more likely to take some risk, and you see some of that risk go into commodity currencies that are more inclined to do better with growth. So again, I think that's helped keep a bit of a bid in the Canadian dollar. But if we were to see crude oil get a little softer and or equities to soften, then I think you could see the U.S. dollar again really outperform, and that big dollar is really going to pressure the Canadian dollar lower. So I think it's very possible that we retest the lows, at the very least, where we were at the end of last year at about 73.5 cents.
We'll have more with Drew Zimmerman right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, if you're looking at a strong U.S. dollar, what does that do to the price of gold?
I think the price of gold could come under some pressure. Gold prices have done very well over the last couple months. We've rallied really $150 from the lows we saw at the end of last summer into the beginning of this year. A lot of that was through the tumultuous time where equities were really moving lower. So to me, I always look at gold in the terms of what is the U.S. dollar doing and what are real yields doing. So real yields were dropping as nominal yields were coming down from the sort of October to year-end sort of time frame. So that was a big help to allow gold to do better. And even though the U.S. dollars, largely stayed steady through that period, it wasn't as detrimental, I think, as the real yield helping gold. And that uncertainty factor, so gold was seeing some of those safe haven flows. But now that we've seen equities, moderate, real yields are moving higher again recently, gold has honestly stayed stronger than I thought it would have. The strong break up through 1,300 and holding that level now has been impressive. I thought we would have seen more gold weakness. However, I think we could possibly see that U.S. dollar break out to levels it hasn't been at in 2 years. I think that would be a big pressure on gold. And then I'm really watching real yields. If we see equities even stabilize at these levels, I think we do see higher rates. That means real yields will be moving higher again. That will be another weight on the gold price. So technically, I'm watching this 1,300, 1,305 level. We had a sort of a false run up on gold today, and now we're closing near the lows. Not a great looking price chart on it near term. I think we could possibly break back down. So I'm watching gold closely. The other thing I'm looking at is silver. Silver's traded weaker. Silver really not looking good today, having a price break, moving to new lows for the month, and to new lows that we hadn't seen since that sharp move higher that both gold and silver got. So I think silver leading a little bit to the downside there makes me a little concerned that this 1,300, 1,305 level in gold won't hold. But again, I'm watching it closely because I do think that if it holds in these levels and the equity market was to roll over, then we could see a period of time where gold and the U.S. dollar are doing better together, as they're just a safe haven asset that people want to move into. So I think that's a possibility of what I would look for. If gold does hold this $1,300 level, then I think you've got to be even more bullish of what gold could do in the months ahead.
Drew, thank you so much for chatting with us.
No problem, Jim. Thanks again.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. If you have any questions, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.